Chapter. We're talking real money.
Hello again and welcome to the show, to the podcast, to the place you go to learn more about how to manage your dough, particularly the investing part. Hello, everyone. I am Don McDonald. That is Tom Cock. We are on two separate sides of the country, and yet we are together for you to help guide you through the really confusing world of money, particularly investing. And by the way, if you want to ask a question, it's easy to do right this very moment if you're listening to us in Seattle or streaming online on a Saturday. 855-935-TALK is our phone number. That's 855-935-8255. Now, I'm going to set today up for a long time. Like going on 40 years now, I've done a financial talk show. That's a really long time to do financial talk. And many years ago, there were a couple of publications out there that often came up on my old radio show. One was called Investors Business Daily. The other was called the Value Line Survey. And both of these claimed that their amazing stock picking techniques, their massive amounts of research and skill generated superior returns. And yet, the reality of the mutual funds that were created using the exact same strategies failed to do well. They didn't do any better. They did worse in many cases than just owning the S&P 500, which was the market back in the old days. So can you beat the market is the big question.
It always is the question. It's always what people want to do, whether they say it or not. By the way, when I meet with you, they're like, I kind of want to beat the market. And I tell them, look, I've learned to accept the market along with my shortcomings. And it just, life is better that way, right? I mean, but let's unpack this a little bit because it's pretty interesting. The idea that you can either take what the S&P 500 gives you, or you can find some sort of alternative strategy. One of those could be the equal weight index, which is something I'm always working on because I'd like to be equal weight, but sorry.
Yeah, well, you are equal weight. Your weight is equal to
what?
or higher than it was in the past.
Exactly.
No, but the S&P 500 is overweighted at the big company end of the market, which is the way it works when you have a market cap weighted.
The value of the firm takes a bigger spot in the index.
Equal weighted will tend to give you a smaller tilt, but the devil really is in the details.
And the execution. This is the part that you just mentioned something very interesting. People can all the time say, look, if you just own these four stocks and you trade them once a year, it'll work out. Well, they forget about the cost of trading. Mm-hmm. They forget about taxation often. And then they just forget about the general execution of all this, which is something not to be overlooked when it comes to your money because new ideas come all the time. Things that work over the long haul, not so much.
It's hard work to manage a mutual fund, to trade the stocks in a mutual fund, to pick the stocks in a mutual fund. All of those things are and any work that is added is going to be added at an additional cost.
It has to be.
And those costs can impact you. And I want to go back to the question I just put to Tom about wanting to beat the market. Do you want to beat the market? Well, here's my question. Should you even try to beat the market? Why would you have a diversified portfolio that's more than just a simple S&P 500 fund? Is it to beat the market or is it for other reasons?
I think it's for other reasons. I think it has to be that diversification over the long haul, while it means you're always going to have to say you're sorry, right? Because one part of the portfolio will be underperforming, should make it a smoother ride. Should, because you just own more things.
Wasn't there a movie where they said investing is always having to say you're sorry?
You never have to say. I did it with my daughter. She's like, please don't sing that on the show.
Sing.
So she told me not to do that. So, but I mean, that's the key, right? Is what is your purpose? My purpose, frankly, is to make a decent return long enough for me, my spouse to live on. That's it. I'm not trying to go to the moon. I don't need to go to the moon. But maybe you want to. I don't know.
Well, and one of the reasons why we believe you should have a diversified portfolio is because even when it comes to just your equity portfolio, if you just have large blue chip stocks in the United States, then when that segment of the market goes down, kind of like it did between 2000 and 2010,
yep,
you really suffer. However, if you had a 100% equity portfolio and you had small company stocks and you had value stocks and you had international stocks, well, all of those didn't move exactly together. Sometimes they moved very similarly, but they moved differently enough that you took a negative return over 10 years and turned it into a pretty nicely positive return over 10 years with just equities, even though what we call the market plummeted.
Which is the approach I think you should take rather than, for example, owning the S&P Equal Weight Index. Add other asset classes, add other groups of stocks. You mentioned small. You mentioned value. How about international? I mean, international has been on a money pouring into emerging markets. We won't even get into that right now. But the thing is, you want to own all those, as you said. I personally think it's just to tamp down on the volatility because not everything goes up and down together. History shows it's added just a little bit of return over time, too, because you're in riskier places. You own other parts of the globe.
And remember, when you hear a great story, you need to ask, what does it cost to implement this great story? What is it going to cost me? And what is likely to be the long-term impact on me? It's turning out that a lot of these things don't add anything, and they can often subtract.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
You know, you got to love the way the financial advice industry thinks and works, because they're nothing if they're not persistent. They just keep trying to pitch you on the idea that there's a better mousetrap that they've made. And usually these things aren't better. And they often just revert back to the old school methods. There was an article you sent me this week from CNBC, Tom, with the headline, "Few active managers beat index funds, but think of them as portfolio teammates, not rivals."
Yeah, one advisor
This
said,
is from a CFP.
Right. Yeah, I know. They're good people. Put them on the bench, too. Why not? Sure,
Yeah,
absolutely.
But, I mean, they give facts like, for example, last year, active funds, in the article, they say 38% beat their passive peers.
Whoa.
Wait. Let's reverse that. 62% failed to beat their passive peers, and you paid more for the work.
Yeah, let me get my coin.
And then they go on to say, well, but then you've got to just be in the right asset classes. For example, among emerging markets funds, 64% of the active ones beat their passive peers. However, if you look at long-term numbers from Standard & Poor's, their SPIVA report, you'll find that over 10 years, every category of active fund management failed to beat their passive counterparts. Every category.
If that doesn't give you the message well enough, how about Jason Zweig, who wrote, "The financial world is full of people and firms claiming that they have the secret, the magic key, the holy grail that will enable you to beat the market. In theory, they're often right. It isn't that hard to outperform on paper. Chances are the theory will not stand up after it collides with real-world costs."
And that's what it always boils down to. And it's been boiling down to that for as long as we can track. I mean, as long as we've had active versus passive, which is 50 years roughly, ballpark, something like that.
About pretty close to that, yeah.
Right around
about
there.
50.
And the problem is for these managers, like the one quoted in this article from CNBC, who was Mike Casey at AE Advisors in Alexandria, Virginia, who says they're teammates. My thinking is he's trying to justify his existence.
I think so. And he's up at the bat and he's at strike two. I'll say that much, Mr. Casey, but that's just me. Baseball is returned after all. So,
wow. That was really fast that you picked right up on.
That just popped into my head.
Yeah.
Speaking of popping, can I mention a little
right back out?
a little program announcement? Is that okay?
What? Depends on what it is. You didn't clear it with me first.
This is going to be for podcasters. No, it'll still be Retire Meet, the in-person event, has a couple of seats left.
Oh, okay. So this is for
like
folks who are going to be in the Bellevue, Washington area, the Puget Sound region.
1 week from today. Yep.
One week from today when this airs on the radio. If you're a podcast listener, don't pay any attention unless you're in Seattle.
Yep. But
what that also means, okay, let me give you a little programming question.
Uh-oh.
I had a thought.
Oh,
I had a
yeah.
thought.
All right.
Here's a thought.
Yeah.
Okay, here's a thought. It's a thought.
Yeah.
I'm going to be doing pretty much alone, but with guests, the radio show next Saturday.
That's right. Yes,
at the Maidenbauer Center in Bellevue from noon to 2. Right?
Yes. I think I'm affirmative on that one. Yeah.
Well, no. Here's my question, and I'm gonna see what you think of it. Before this is not a
this
promise.
Is my opportunity normally, you're the one who says no. I'm looking forward.
This is not a promise, but I had an idea because I know a lot of people really like to come see a radio show. You know, it's like,
very exciting.
I'd
see
love
a guy
this.
sitting up on stage.
I know. I
talking.
find it really boring, but it worked for us all over the
let's
country.
Be honest. We've done that for 10 plus years, and there's not that many people that watch. A few.
But what I was thinking is for those few, because maybe they can't make Retire Meet in the morning, is that after lunch for the 1 o'clock hour,
yes,
that we say, if you come by Maidenbauer, you got to pay for your own parking, get your own parking. If you come by, we won't. You can come in.
Free?
You can get in for free to watch the show.
Yeah. Hey, what do we care?
Which is in another room, right?
And if there's any leftover vegetable sandwiches.
There might be a couple of veggie sandwiches, but
from 1997.
what do you think of that idea?
I love it. But as I said, what do we care? Here's what's going to happen. You and I are going to say, this is a great idea. We're going to forget to tell people. And then they're going to show up at the desk. And they're going, what? No, you can't.
No, here's
do
the thing, is I know Debbie's listening
sure.
to the show right now.
Oh, Debbie will handle it.
And so she
I didn't
keeps
know
track of
That's
things
true.
better than I do.
She's
way much better organized, much more organized than I am.
No, I think that's a great idea. So, and by the way, in the 1 o'clock hour, you'll be able to see you interview the great Christine Benz.
Exactly. That's what I thought was kind of cool. So it'd be me and Christine.
And you could ask her questions,
and I'll do Christine. I'll probably have Joe Salcihi, too, at some point.
I was thinking he'd be the first hour, but that's just me.
Oh, maybe he'll be the first hour. Oh, I don't care.
It's easy cut. Yeah, I think it's great. Okay, so if you can't make Retire Meet in the morning for reasons I don't understand, but maybe you want to see your grandson play soccer or something, which is what I'd rather do.
You don't want to spend the money. You're a cheapskate.
Well, that's true. Okay, you get in for the afternoon free. So you're going to get in a lot of trouble for this. But anyway, yes, you show up.
No. It's only for that 1 hour, and then you're out.
Oh, at 2 o'clock, you're going to escort people out of the building?
We're kicking you out of the building.
Come on. There's some pretty good stuff in the afternoon, including the Q&A.
Yeah, but they don't necessarily, if it's sold out, they don't have a seat. So, no, don't invite them in the big room.
Oh, for crying out loud. Show up at 1 o'clock. We'll see what happens. There's always people that leave. Seems like there's always empty seats in the afternoon. People get to about noon and go, that's enough of this. I'm out of here.
Oh, now you're really helping ticket sales.
Exactly. So go to retiremeet.com.
You made it sound incredibly boring.
My daughter I've been working the jokes with her, and she's like, this is the worst, Dad. This is the worst it's ever been. I said, oh, come on.
No, really, lately they're pretty much the worst they've ever been.
Do you want me to try one right now?
No, I really don't. But but you're a co-host, so you can do whatever you want. But don't ask me to condone it.
Or laugh,
I am not condoning your behavior ever.
Titter or something.
Quick, you got 30 seconds.
No, I'm not going to do it. I'm saving it. You show up for Retire Meet, and I'll ladle it on thick.
All right. In the meantime, give us a call. We've got all of our lines open, which means no one's on them. 855-935-TALK is that phone number, so dial that.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Now, there are several ways to ask us questions. When we're doing the show live on a Saturday, noon to 2 on the West Coast, 3 to 5 on the East, you can call 855-935-TALK and ask us a question. It's easy, and we're live together, so it works out really well. We can interact, as long as Tom doesn't tell jokes. Or you can go to talkingrealmoney.com, hit the contact button there, and you can type your questions, which for some reason all of you seem to like speaking with your fingers, or you can speak it with your mouth, which is I thought was the preferred method of communicating, but apparently not anymore.
No,
because
texting.
I was definitely whining about not having enough callers. As a matter of fact,
not helping.
I don't have enough called-in questions to do next week's show. I need.
Okay, so what number do they call right now?
Right now they call 855-935-TALK.
Okay, so
that's
very
the one.
Confusing. That's all.
855-935-8255. Now on a Saturday, that's when you call that. Does that make sense?
After the hours today, then you call the other number.
No, that's not another number. It's just contact us.
Oh, that's right. You go to the website.
You go to the website.
Okay, it's very complicated. That's what I'm saying. See, that's why.
He's getting a little feeble-minded.
Well, when you get to retirement, 3 things do happen, right?
Oh, no.
Number 1 is you forget stuff.
Yeah, what's number 2?
Oh, God, I forgot.
Yeah, I knew it. Okay. So I set him up for that, too. It's my fault. Okay, 855-935-8255 is the number, or send them in at talkingrealmoney.com. And here's a send them in. I just threw it to you.
Comment,
send them in.
by the way. Yeah, perfect. There's a comment from Doug in Minot, North Dakota, which is known for what? It's ICBMs and what else? I don't really know.
Vast open spaces.
Okay. He said this comes up because we talked about small businesses getting retirement plans. How to find them.
Okay.
He says, I have a dental practice with a half a dozen employees. We decided to drill down on the opportunities in the 401k market. All right, I added that part. He said they've used an employee fiduciary for the last 13 years. The fees I pay are very reasonable, and I'm allowed to populate the plan with almost any ETF or fund. Now, I don't know, Doug. They're still working on adding ETFs to 401k, so he may have been a little confused.
Yeah, I think it's mainly mutual funds. Let's just
mutual funds.
Leave it
he
there,
says he primarily is offered Vanguard with several Avantis funds, and he linked to the employeefiduciary.com/401k. So, in other words, the point is, small businesses have options. They have way more options than they had 20 years ago.
Oh, yeah.
And you don't need to use an insurance company for these. You can go, I think you looked it up, right? I mean, even huge folks like Vanguard will take small plans.
Yeah, they take small plans. Yeah.
Yeah. And so, or Schwab. So, this is a very kind comment, Doug. Thank you for that. And that sounds like a plan you can really sink your teeth into, I'd say as well, probably.
I don't know about the, like a solo 401k. I don't think Vanguard charges to set those up, do they?
No, I believe you could just walk in the door and start.
Whereas
this is something that came up recently too, by the way, and I put this on the list, but you wouldn't let me talk about it because it's too political. But this idea that we need to have new ways to save for retirement, new things, new methods. There's a lot of methods. You just got to do them.
Okay, I wasn't going there yet, but okay.
Where
I was going was I looked up employeefiduciary.com.
Yes.
And for a solo 401k, which is the simplest one, they charge $250 up front.
I think you can go to Schwab and set that up.
And then they charge $500 a year plus 0.08% plus the cost of the funds.
This guy has a dozen employees, so maybe it's cheaper when you have a dozen. I don't know.
No. For regular 401k, the establishment fee is $500.
Yeah.
The base fee is $1,500 a year plus 0.08% plus the funds. So
maybe Doug was taking the laughing gas prior to writing this. I don't know.
No, I mean, I don't think that's terrible, but
you could do better.
I think you could do better. I may be wrong.
The point of the matter was when we started the conversation regarding this was you can't find place to start small plans, and the answer to that is that's incorrect.
We didn't say you can't.
No, somebody else said that.
Oh, I was going to say.
Somebody said, I just can't do it. And we said, the options are out there. You just got to go find them. Sure. As I said, way better than it was 25 years ago.
Yeah, way better. Hey, our number is 855-935-TALK, 855-935-8255. We have a lot of lines open, but not all of them anymore, okay? One of them is full, but we can fill up the rest. 855-935-8255.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Before we move along to our call, hopefully calls, plural, I did some checking on Vanguard. Vanguard sold off their 401k custodial business to Ascensus.
Yeah,
with whom they work very closely. Mm-hmm. But here's the deal. For a small plan at Vanguard, there is no setup charge.
Now, solo 401k? Because that's as small as it gets, right?
I mean, this is a small company 401k, which is bigger than a solo 401k.
Right, which is one.
But a solo would be the same. They're the same. Solo or small company.
How much?
Upfront fee, $0.
Wow.
None.
It's a good deal.
Okay. Fee per active participant. Mm-hmm. The administrative fee, $20 per participant every year. Vanguard charges $20 per mutual fund account for their reporting, plus the fees, the internal expenses. That is so darned cheap.
I think we're paying more.
Of course we're paying more.
But are you paying it, or is the company?
No, I think the
paying
company's paying it.
Oh, okay. Because
I'm
I keep
not
asking them
paying
to add certain things, to add portfolio stuff.
We've
Like last week, I wanted to add futures on my tariff refund. Trade that a little bit, but
that's on the. You can do that, I think, probably on the betting markets, whatever those things are. Those guys.
Prediction markets.
Yeah, whatever they're called. I don't. Go play. Have fun. 855-935-TALK is our phone number. Dan in St. Paul, Minnesota. You're up. Welcome to the show.
Hi there. Thanks for having me.
Glad to do it. What's up?
Okay, so I'm trying to establish when I do a portfolio rebalance, what to rebalance to. And I know that there's a lot of different ways of slicing and dicing it. One would be, percentages in small, mid, large, growth versus value, sector weightings, and then international, and then kind of a side question. In international, you kind of just drop it as international, but the size, small, medium, large, value, growth matter there. And then as far as bonds go, I know you've talked about BND, and is that a diversified enough bond portfolio? Kind of anyone can use that, or is it really something where you need to zero in on corporates versus municipal versus treasuries?
First, let me just say, BND a bond fund doesn't get any more diversified than BND. It's every bond in America.
Yeah, it basically
every
is.
taxable bond in America.
Now, the only other diversifier you could have international bonds.
That's it. Yeah. But here's your question. It confuses me a little bit. You're saying, what should I rebalance to? Do you already have a properly balanced portfolio, or are you looking for a portfolio starting point for future rebalance?
To fix
a starting point, and then on a quarterly basis, semi-annual basis, go back to those things. But I need to have what's the benchmark to go back to?
Got it.
Okay. Well, the first one to decide
I want to look at that.
The first one to decide would be how much in stocks and how much in bonds. Correct?
Yep. Stock bond ratio.
Okay.
That would be the first, right? Then after you've done that, we've already established if you're going to do this on your own, it's going to be pretty simple. The bonds just go right into a BND, for example. Could add a little international if you wanted to make it more complicated. Okay. But then on the other side of the equation, things get a little more complex. The first separator you have to do there would be between the U.S. and international. Now, I have 65% of my money in the U.S. when it comes to stocks and 35% in international. Don has 50-50.
55-45, roughly.
55 U.S., 45. Okay.
Yeah,
So you'd have to make a decision there, right? That's one decision to be made. Then after that, that's where the breakdown really, the work really begins, because then you need to have big companies, right, in both U.S. and international. You need to have some big growth companies in both. And then you need to really focus on small and small value companies in each one of those U.S. or international too. That's where the complexity.
May I interject?
I just wondered when you were going to.
May I interject? How large is your portfolio, Dan?
About $3 million.
Okay, and where is it now?
Physically?
You mean custodian, or how is it invested?
How is it invested now?
It's a combination of funds and individual stocks, mostly large growth, or large S&P companies.
The
hodgepodge.
The hodgepodge.
Yes.
The hodgepodge.
The hodgepodge. All right.
Okay, but part one is, so how much, and so just since we're doing it, how much in like pre-tax or qualified money, and how much in brokerage?
Brokerage probably have in pre-tax. Well, it's probably closer to $4 million. So I'd say in retirement, $3.2 million and $800,000 in non-retirement.
If you are not planning to let a professional build a portfolio for you, if you're going to do this on your own, you're probably not going to do well, because we tend to get, like you did when you bought stocks, we get emotional. I see absolutely no downside, and I mean no downside, to just establishing your stock-bond ratio and stopping there. Figure out how much risk you need to take and you can comfortably take. Then you figure out what that is, 60-40, 70-30, 50-50, 40-60, whatever that number is. Then you take half, you put it into BND, and then you take the other half and you put it into DFAW or AVGE, because both of those have more than a dozen mutual funds already in there, and they are being professionally rebalanced between large and small and international and U.S. and all the things you're trying to do, along with some real estate and some emerging markets that if you tried to do it on your own would require you owning a dozen or more funds.
And that's exactly the point. Doing it yourself, again, the simplicity, I love. And by the way, you said mutual. They own a series of mutual funds. They own a series of exchange-traded funds.
Yeah.
With no additional cost.
Potato.
But this is a very good point that Don's making, because, and it just came up at the beginning of the show, like just doing things pretty simply. Here are my stocks. Here are my bonds. The rebalancing is simple. The keeping track of things much easier than having all those funds.
We work way too hard on this because we think we need to overthink investing because of our exposure to the media. Stop watching or listening to most financial media except Talking Real Money. Build a portfolio of 2 ETFs, BND and AVGE or DFAW. Let them do it.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
The goal of this radio show and podcast is to make you a better money manager. It's to make you certainly a better investor. And the reason we want to make you better with money is so that you can have more of it, so your future is better. That's really the whole idea behind
Why didn't
this.
you just say that like 15 years ago, and I would have taken all these weekends off?
Well, do you have any place better to be?
Not particularly.
Not really, no. You would have been.
That's not true. I would have been at my grandson's soccer game today.
Oh, you're missing a soccer game?
He scored a hat trick again. He is truly the best player on the field.
Really?
I'm not just saying that. Yeah,
it runs in the family, huh?
No, I never was the best player on the
field.
field.
No, but your son was pretty good.
He was pretty good. Yeah. Okay.
Right.
Yeah. If he's listening, yes, you were the best player on the field.
Taylor's not listening.
No, he's not listening.
He's not. There's no way he's listening.
No, he isn't.
None of my family listens.
I know. It's okay. My wife, I'm sure, listened. But
I'm sorry, Debbie. I know you're listening.
Yeah,
I'm sorry.
Listens.
My
wife listens when she's in the car during the show. She finally figured out how to do that like a couple of years ago.
She finally learned how to listen to the radio?
I think so.
Wait. Listen to the radio? The thing we've been listening to in the car?
Remember, there were all those years where she thought when I went to the studio that I was just down messing around. She didn't know I was doing a show.
It's on the radio, like the radio that we've all been listening to since the 20s.
If you want to tease her next week as
I will.
You can take it up with her.
You didn't know how to use a radio?
No. She didn't know that we were doing this show. She knew how to use a radio.
Oh, so. She knew how to use a radio, but you didn't tell her you were doing a radio show. Well, then that's on you.
I believe I did.
That's totally on you.
Well, like everything else.
He was trying to keep it a secret. It's like, don't listen, please. 855-935-TALK is our phone number. Let's go over to Seattle, where Dee Dee may be driving around. Hey, Glenn, welcome to Talking Real Money.
Hey, guys, how are you?
Good, thanks.
So I am, my question is, I'm retired, and I've listened to you guys for years, so the stock portion of my portfolios are in dimensional funds.
Good stuff.
My brother has done quite well over the years, and what he's done is to analyze companies like Warren Buffett does, and he claims he's done better, and I'm sick of listening to him. Do you have a response to that?
Let me see his tax returns for
let
the
me
last
see his
20 years.
Let me see his portfolio statement. Maybe he did.
Right. There's an aspect of luck, of course.
My guess is, given the fact that when we talk professional money managers, less than 20%. I don't have the latest figures across the board, but generally speaking, less. Well, no, I'll give you an even better number. And there are 2 different studies done, one by the Swiss Finance Institute and one by Professors Fama and French. They both took a group of mutual fund portfolio managers that outperformed the index. Then they adjusted their results for luck. And both studies independently found that after you adjust for luck, less than 1% of people managing money professionally beat an index, much less anything
but that's
else.
not going to. That argument's not going to work with his brother.
No,
He can say,
it doesn't.
yeah, so what? I'm not that
Okay,
guy.
and here's the thing.
I'd have
Over
to see
what
it year by
period, by
year.
the way? Wait, hold
Yep,
on. This is
exactly.
really critical. Over what period, Glenn?
Probably 30 or 40 years.
Wow.
You'll probably have the edge 30 or 40
Yeah.
years. If it's 10, he might
That's
have the
true.
edge if he was an S&P 500 kind of investor.
How important is your relationship with him? I mean, because we can give you all the evidence, and then just that'll be that. You won't see him again, but you will have won the argument. You'll be wrong, but you'll be right, but you'll never see me again. I don't know. So,
Okay, no, I'm happy to hear that you don't make the exception for Warren Buffett.
No, are you
Buffett
kidding?
had a great period of overperformance. It hasn't been that great the last 15 years, by the way. So, and he has.
Yeah, but my brother.
Your brother?
Yeah, my brother says that Warren Buffett even now recommends people buy index funds.
He does. He's recommended
He
that for a
has
decade or more.
decades. Yeah.
Yeah, for a while. Yeah,
And remember also back to the Buffett returns. Mr. Buffett has certain advantages, right? I mean, he loaned Goldman Sachs $10 billion in 2008 at 10%. He's done all kinds of things.
Plus, he
that you and
also
I just
ran the
can't do that.
businesses.
I was getting to that.
Yeah.
He's a business operator more than a stock purchaser. So that's not a good comparison.
Yeah.
I think a better comparison would
Got
be,
it.
for example, and you could do this. You could take the S&P 500 index fund. That would be one. Then you could take, and by the way, you can go to IFA.com. They've got the returns that are pretty close to what you and I do, Glenn, since you're using dimensional funds, going back to 1928.
Yeah.
So you could go year by year and say, here's this index style approach, has a tilt to small into value. How's it done? So you could line those up against each other to see. It
And
would
it's
be hard
funny,
to
by the
believe,
way,
but not impossible.
Berkshire Hathaway and dimensional core equity, U.S. core equity, U.S. core equity, have almost exactly the same performance over 30 years.
Interesting.
Really?
What about
And they
what about
both beat
small
the
cap
S&P
value?
500.
What about the targeted value?
Oh,
from
I don't know. I'm not
dimensional?
getting into the
Anyway,
the
that would
weeds.
be the one I'd want to see, because that would be small value stocks.
But the reality is, so what? He worked harder than you did.
Yeah, you know what? Don't
Yeah.
invite him for Thanksgiving
Yeah.
next year. Just get it over with now. Just say no.
Yeah,
you're not
if he
coming.
beat you by
Yeah, no, he
1%,
lives
just
in
take your
Washington.
1% out of the turkey.
1%.
Yeah, all right. Well, he lives in Washington, D.C. I
Oh,
live here in
perfect.
Seattle
That's good. Yeah.
with you guys. So, yeah. Well, thank you very much.
You're welcome. Thank
This is
you
great.
so much
I
for
love
the
your
time.
show.
And I hope people know I'm kidding. If people bring this
Really?
up with
You
me,
kidding?
Yeah, I know.
No.
If people bring this stuff
You're
up
so
in my family,
serious.
I just walk away. I literally, I had an argument with someone in the family about Social Security once. That one, I actually went and got the book to show them.
Yeah.
They're like, no, it's not how it works. Yes, it is how it works. No, I said, I do this for a living. Ah, right. I finally had to go get the book, show them somebody else's work and say, don't trust me. This is,
I don't care if you do this for a living. I'm
It
right.
doesn't matter. You're wrong. Yeah.
855-935-TALK. That's the number to call us on Saturday afternoons. It's so easy. We'll answer your questions. We'll have a nice chat. It'll be fun. We'll discuss Thanksgiving dinner next year.
Argue.
Argue with you. Whatever.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
By the way, in the Seattle area, you may have just bought Microsoft in 1985 and held it to today. What's been the annualized return of that? Probably pretty good.
Probably pretty good. And that's a luck.
yeah.
You see, that would be a luck. That would fall
be.
under
No,
luck.
I knew Bill Gates in high school, and he's a genius, and I decided to sign up. So
Let's go back to Seattle. Dale, welcome to the program.
Hi, thank you for taking my call. I've got a question about retirement.
Yes, sir.
I've attended multiple times, both in person and as a virtual attendee. I was planning to go this year, but I'm going to be out of town. And I remember when I was a virtual attendee last time, you guys made available copies of the handouts and PowerPoint presentations for attendees to download sometime after the event. Mm-hmm. I'm wondering if nowadays you might also be making available video recordings of the presentations on this coming event, such that if I register now as a virtual attendee, when I'm back in town, I'll be able to view them.
yes, is a short. By the way, you can come by my place this afternoon. I've got all the handouts if you want to pick those up ahead of the event. No, I'm kidding about that.
joke.
But,
Thank you for that.
But
no, 'cause
yeah, you
nobody can find
absolutely
my house.
can.
Yes.
We're creating a
Yeah.
video of everything.
Oh, yeah. Everything's video. It'll be up there. You can watch it all later. Sure.
Yep.
Wonderful, wonderful. How long will that be available online? Through the end of March?
Oh, how long until it's available?
Yeah, it might take a little while. I don't know how long.
So
they take.
here's the way the process goes, Dale.
I'm in no rush. It's just
okay.
I'm more concerned about how long it'll stay up once you put it up.
A long time, until next whatever, months and months and months.
Oh.
So here's the way it'll work. It won't be one run on video though. They will edit out my bad jokes. They'll edit out some other stuff,
which means about half the presentation is gone right there.
So it'll be, but there'll be
That's
Don's, then Tom's, Paul
Premium
Merriman.
material.
That stuff will all be up at one at a time. But they'll make that available to you.
Perfect. I'll sign up right now. Thank you very much.
No, thank you.
All right. Thanks so much,
What a
Dave.
great. Did you know that was coming? What a great lead in. All right, ladies and gentlemen, you need to be there. You got to show. I'm sorry. It'd be great if you were. We still have a couple of seats.
You need to be there to feel the electricity in
it's
the
just
air.
a whole different thing. It's you can touch Paul Merriman's robe. You could rub Don's head.
Is he wearing
it's
the
all
robe
available.
again?
Oh gosh, yes.
I love the mini colored robe. It's like
I know
Paul in the mini colored investment coat. It looks like his charts. No, actually, it looks like Mark Hebner's charts.
Good Lord.
Many colored charts.
Talk about handing out a lot of paper. So that is a week from today, and it's in Bellevue at the Maidenbauer Center. And, yes, there are still a few seats, breakfast, lunch, et cetera, at retiremeet.com. How's that?
That was pretty good. And here's what really impresses me is you got all of that in, and we still have a minute to kill.
Okay, so you want some more of the jokes I'm working
No,
on?
no, I don't want any more jokes.
Okay.
I just thought I wanted to congratulate you and have you just be quiet for a moment. I thought you'd be happy.
Standing down.
I'm just going to tell you about how you ask questions. Because we do this show on Saturdays, but we do 5 podcasts a week, right? The show turns
Believe
into
it or
a
not.
podcast.
Yeah.
But the rest of the time, we love taking your questions, particularly on the Friday Q&A show, which requires cues for me to A. I can't A without Q. I don't know how that formula came about, but it's mathematical. I need a Q to have an A. And to get those cues, you have to go to talkingrealmoney.com, click the contact button, and then record your message.
That's why I don't want to retire. Everything's just starting to click now. Like my neck is clicking, my arm is clicking, my knee is clicking.
Yeah, just go to talkingrealmoney.com, click on the contact form and record.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.